It's March 19th. Hope everybody's having a great day. Let's get it started.
Welcome to the show, it's Mortgage Talk. Grab a coffee, sit, and let's unlock the dreams you've got, the place you crave. From the front porch swing to the hidden cave. Talk about your home, talk about your plan, talk about the future where you'll stand. Your mortgage, your dream, your story to give. Let's talk about the place where you wanna live. Got questions? Here's the place to be. A TikTok Live Mortgage Jubilee. Fix or float, we'll break it down. From city lights to your small town.
All right. Thank you guys so much for joining. My name is Kenny Murden. I am newer to TikTok. I'm not new to lending. I've been lending since 1999. And in that time, I've been a fantastic resource for both real estate agents and loan officers to structure some of their more difficult deals, which makes me well qualified to answer any questions that you might have about real estate or mortgage in general. And as I like to start every show, I like to price out this deal here, which is an FHA purchase for a $400,000 house in the state of Texas. And what I'm looking for is not only the rate, but also wanted to see, if I pay less than a half a point in lender paid points to get a rate, what would that be? So here at 5.5% rate, today we are at 0.41%, which is the closest to that number. So it's $1,600 about in lender fees to get the 5.5 rate, which means that rate stayed about the same as yesterday. They got a little bit worse. And so let's take a look at what the yield does, where the bond market is moving, where it's going to move rates the most. And it looks like that red number is good, but it's not a very big number. So it's a very flat day. So that's why rates didn't move very much. But if anything, they got just a touch worse for that one scenario. That's not saying that some other scenarios might have got better, might have got worse, who knows. But if you have a scenario that you want to get priced out, go ahead and throw it in the chat, and I can price out your loan scenarios right here live on TikTok. Or if you prefer more of a private conversation or quote, you can screenshot this. You can call or text the phone number listed above, and I can send out an application link where you are able to just go apply online, get the process started, and then I'm able to give you a written quote that I would email back to you. So for those of you that are looking for pre-approval letters, we can do that same day. I can also, in addition to pricing out some different loan scenarios here, I can also answer questions like, if I make this much money, how much house can I buy? And I show people how to calculate that quick and easy. So just that, and then any other questions that people have, feel free to shout it out. But all day I've been playing with AI, and it just blows me away what I'm able to accomplish with what's going to be replacing us all, me included, very soon. And so it was giving me some advice on things that I could talk about on here. So the first one was a question where it's kind of mortgage, real estate related, and just kind of throwing out Q&A, and then then I'm looking up the answers. So it says, what's the most expensive home ever sold in the U.S. and who bought it? So then I looked that up, and it says the most expensive home sold in the U.S. The record for the most expensive home ever sold belongs to a massive multi-floor penthouse in New York City. The property is 24,000 square foot mega penthouse, at 220 Central Park South in Manhattan. The price was $238 million. The date of the sale was January of 2019. And the buyer was Ken Griffin, the billionaire founder and CEO of a multi-national hedge fund called Citadel. And it goes on to talk about how it's basically a whole bunch of floors on this very tall 79-story luxury residential tower overlooking Central Park, blah, blah, blah. But yeah, it was just kind of like interesting as I was working out some of my workflows and things that I've been working on. Some of the feedback that I've been getting from, and right now I'm using Claude. I know a lot of people have been shifting over from ChatGPT over to Claude because it's able to actually kind of take over a terminal and do real work with you and for you. And so that's kind of what I've been playing with here lately. Have you been using AI at all in what you're doing? Are you using it for entertainment purposes? Are you using it just kind of like you use Google to look things up? I'd be curious to know, how everybody is kind of using it, if they're using it at all. Some people I talk to, they're just like, they're on. I was actually a really late adopter to use a smartphone. I didn't think texting was going to catch on. So like, and you have to like press the number 3 times to get the third digit. I just thought that was so inefficient, and I didn't have the foresight to think that they're going to have the full keypads, even when the BlackBerry came out, and you kind of had to like, just thought it was inconvenient to have to, use the buttons were too small, I think. But now with talk to text, the way that technology is just taking over has been amazing. And one story I shared yesterday on how that was impacting my industry. So I've been, I don't know, not to like toot my own horn too much, but I'm good at mortgages, right? So I know a lot of the different kind of trivia things about mortgages and loans. And I was, helping a newer loan originator figure out what she was working on. She was putting together a loan scenario for somebody that was doing a fix and flip type of a loan. So they're looking for what does it cost to acquire it, and they want to use the least amount of money possible to acquire the property, fix it up, and then sell it. And so the way I explained that was, so I went to a fix and flip loan guideline, which tells you can acquire the property with 10% down, and then we can finance up to 100% of the fix up. That's just kind of standard how that works. And what she did is she went to AI, that's going to replace us all, me included, and she got a better answer where instead of using a fix and flip loan, it used a bridge loan that got them closer to no money out of pocket. So I thought that was pretty brilliant, and I was really proud of her for using that. And I'm like, yeah, I guess I was stuck thinking about the narrow view of the loan that she was asking about. But once I was caught up to what she was talking about, where she was taking what the customer wanted and used that context, it made a lot of sense that it broadened that horizon and looked at other alternatives, where I was very much stuck on it. Like, if you come to me and say, hey, what are the interest rates on a 30-year fixed loan? Then I'd say, okay, are we talking about conventional, jumbo, FHA, VA, whatever? And then I can look that up because it's a very narrow scope. But if we're, hey, awesome, Kenny, how you doing? So, if you get narrow focused on what they're asking about, sometimes just hanging around. Appreciate you. Same. I've just been I've been playing with AI all day today, all flipping day, and it's pumping out some gold, absolute gold, some fire. I have some unused URLs that I just forgot about. And some of them have some really fire keywords that AI was really excited about. And so it's going to take the transcript of these lives that I'm doing and it's going to whip them up into blog posts for me automatically and put that out to the interwebs and maybe attract some more traffic. I'm looking for a mortgage company, FHA, that will take 52% debt ratio, 205 salary, 760 credit score. Now that is fine, right? You're still within the 57%, which is allowed, but I don't know if you're familiar with the front end versus back end ratios. So as long as the front end ratio is lower than 47, you're fine. And that just is housing only, no other debt. So if you don't have a whole lot of other debt and you're still at 52%, then that might be where you're running into an issue. But if you have some other debts and your housing is less than that 47, then you're allowed to go all the way up to 57. So I wanted to make that point to you if that's what you're running into as an issue. And then we do have other scenarios that we might be able to help you with as far as that goes, but you have a fantastic credit score. The 205 salary here, I'll share my screen here and I'll show you how to calculate this here. I must have restarted my computer today because that's what the calculator looks like when I do that. But we'll take your 205 salary and I'm going to divide it by 12 to get your monthly, and I'm going to divide that in 2. So that's approximately where we want to keep your total payment under, even though we're going a little bit above that at 52. That's fine. And then FHA will take 52. Trying to see what part of it, I'm trying to buy another house and approve sellers won't take contingency, and it's 52% with current house and new. Yeah, so I think you're fine there. Is your first house owned as an FHA loan? That's my first question there, because you can only have 2 FHA loans. If it is, then is the second house, does it have an extra bed? Like it's a conventional. Okay, yeah. So you're probably good as is. So I would definitely reach out. You found a solution. I can send you the application link. Reply to to the text message. Second house, it has more square footage. Perfect. Now, if it was the FHA restriction that I was talking about, it's not just the square footage that would be an issue. You would actually need another bedroom. But since the first one's conventional, doesn't matter. You're good to go. I don't see any roadblock into what you're doing there. Let's see. Do you know anyone who would invest in small liens, writ of executions, and non-homestead properties? It's a long story, like a court judgment that's been recorded on someone's deed. So I would, so I don't know exactly who you are, JMMJ, but my question is, if you know who I am, do you know who Brent Berry is? So I would put you in touch with him. I would put you in touch with Ryan. These are some people in my inner circle that might be able to find some of the stuff that you're looking for. And right now they're raising a whole bunch of money. Okay. Well, let me ask you this. Do you know who I am personally? Because I don't know exactly who you are with the anonymous account. So if you don't know me, I'm happy to introduce you. Same deal. Screenshot this or text me above and just say you're looking for this. Okay, yeah, you just found just scrolling. So a lot of my friends will pop in here. That's why I was asking. But yeah, if you're looking for what you're doing there with the finding unique financing, I would get you in touch with those guys, and they might be able to help out. But let's just get let's get a longer form, kind of a letter of explanation of the scenario, and then they will be able to present that to any hard money investors that they're trying to run down, because I think that's where you're going to end up. And if it's something that we're able to tie to real estate, awesome! I just got your text message. Got it. So I'll reach out to you after. I'm only on here for an hour every day. So once I wrap up the hour, I'll text you back and we'll work on getting kind of a letter of explanation. Yeah, it's tied to the guy's house and it's transferable. So yeah, that sounds like it's got legs. Maybe I'll be able to help with it. Maybe I'll be getting them involved. But I have a lot of different hard money folks, as well as, the whole scrutiny of, conventional lending and non-QM, all of that. So, I'm with the largest mortgage brokerage in the country. We have almost 300 different lenders that we're tied to with, 1 second. Oh, no, it's nothing. So I basically just have a lot of different options here. Since it's only a couple of grand, it's pretty much private party thing. Those Midland guys wouldn't bother with it. Yeah, if it's only a couple grand, then anything really small, I just, I would look at almost like the credit card type fundings, like personal loans, that kind of thing. So if there's a credit issue or something like that, I don't know. I guess I would have to find out a little bit more about it and see if maybe it's something that we can, call those guys and they only go with banks and stuff. Yeah, I mean, if we're only talking about a very tiny little bit of money, as long as there's a return for whoever's investing it, there's, a lot of people that might just do what's it called, peer-to-peer, P2P type deals. They have contracts with credit card giants. Yeah, I don't like bundlers though. That's like a bad deal. I mean, you can just apply to, it's basically like, yeah, but I mean, like, if I was going to go and apply with like a Capital One and a American Express and, so on and so forth, and they're going to bundle and they say they're doing me some kind of a service, and then, yeah, charging, ungodly upfront amounts that they basically then run your credit card to pay themselves. I'm not a fan. Like, I want to pay the least amount of fees, the least amount of interest. So that's not my favorite form of lending that I would personally do. But so yeah, I don't see the point in those companies. Yeah, I mean, I get why they do it, right? And they sell it by saying, hey, we can help you raise like $300,000 unsecured, and so they're selling the sizzle, and then they get you on the hook, and then they get you to the end where they're like, oh yeah, and by the way, we're just going to basically apply to a whole bunch of credit cards, and then we're going to run the credit card to pay ourselves. Like, and I don't think you need to be licensed to do it. It just seems like when I scroll on TikTok, I get this one that's like unethical ways to make effing money. Sounds like one of those to me. And they offer like 5 cents on the dollar when it's usually worth 70 cents per dollar. Yeah, I just, if we were able to just find, a one quick and done solution, but I would just need to understand, what the collateral is, what the dollar amount, if it's only a couple grand or whatever, and then like what would be the repayment, right? So the better I understand the cycle of that transaction, the better I can point you in the right direction, or just find somebody that'll just throw the cash on it and make it easy for you. But obviously they'll want to paper it and make sure that they're going to get their money back. So but I appreciate the questions there. And then as I was playing around with AI today, what was the other thing here? I wanted to run this one here. It was asking, because we've talked about this quite a bit, if you put $1,000 a month into a mortgage versus investing it in the S&P for 30 years, which one wins? So I wanted to run that one and see what it says. But JM says, right, like eventually someone would have to foreclose if they don't get paid from the debtor totally. Yep, exactly right. They just want to make sure that they're getting their money back, and they wanted to do it with a little bit of incentive, interest, but not usury. Like there's usury laws, and maybe that's what those credit card bundlers need to look at, because it seems punitive, the amount of money that they charge. Let's see. You already know the mechanics of amortization inside and out, so looking strictly at the opportunity cost over 30-year horizon, the S&P 500 mathematically wins in almost every scenario. The answer comes down to a straightforward comparison between mortgages. And so this AI knows me, though. Like I ran this scenario where I was asking it, like, if I were to rent one house versus own another house and invest the difference, and I was giving the owner like $500, and then the rent I think was less, because there was an advantage to the renter not having to put a down payment or whatever. So I ran this scenario. So I think it's funny when this thing's coming back to me and talking to me. It was like, you already know the mechanics of the amortization inside out. So it's like, that was like its first line as it's answering my question. Again, the question was, if you put $1,000 a month into a mortgage versus investing it into the S&P 500 for 30 years, which way wins? I don't know if it understood, like, obviously you'd also need the value of the house to be going up. So let me read on here. So the S&P route is compound growth, yes. And let's see, mortgage route, guaranteed yield. What is it calling yield? If the mortgage is locked at 6.5, that $1,000 is a month essentially yields a 6.5 return. Okay. Let's see, key factors beyond the raw math. Yada yada. Ultimately, as long as the market average return outpaces the mortgage interest rate, investing the difference creates significantly more wealth. Would you like to run a comparison? Okay. So yeah, basically it got down to the same thing I've been saying. Like, I would rather finance more of the house and use more of my cash to invest in another asset. Philip says, I'm blessing the first 5 people to message me. God did. Stay safe. Okay. Thank you, Philip. But yeah, so what I've been talking about, a lot of people are asking me, like, hey, should I put more money down on the house, more down payment? Is that a good strategy? And I can't give financial advice because I'm not licensed to do so. But my opinion, for entertainment purposes only, is that I would rather put my cash towards a different asset other than real estate. And the way that I phrase that is this. I say, I don't think real estate is going to do in the next 10 years, as far as asset appreciation, what it's done in the last 10 years. And there was something in AI's little tidbit today where it was talking about that. Let's see, where was that? Anticipated, yada yada. It was giving me a lot of information. I was reading through it, but it was basically where prices are staying steady, and in some places it pointed out, like in Florida, there was actually a reduction of value, or home prices were kind of coming down. Where did I see that here? Oh, here we go. Home price growth has cooled dramatically. Only 0.7% year over year nationally, down from 3.5% a year ago. some markets like Florida are actually down 2.36%. Meanwhile, the spring buying season is showing more inventory than we've seen in 3 years. So what they're saying is actually this is one of the best negotiating environments for buyers in years, meaning you have more leverage to come in and offer a little bit less than what they're asking. Prices are soft, inventory is up, and sellers are motivated. You're not competing in a bidding war like in 2021. The rate isn't your enemy. Then it goes on to give the whole date the rate, marry the house kind of a thing, which I think is gross, but it's a popular thing that's been kicked around. But ultimately, when I'm so that's AI. But when somebody's asking me about if now is a good time to buy, the first thing that I do is I talk about the hidden cost of homeownership, which is the cost to sell. So I want to make sure that people are going to be staying in the property long enough for the appreciation of the property to take place to at least cover the cost to sell. And so one of the examples that I give for simple math is if you have a $100,000 house and it appreciates to $110,000, it might be easy to think I just gained $10,000. But if it costs 6% to sell the house, you've only gained $3,300. And that's a significant thing because you take this $100,000 asset and give it 10% in appreciation, you're only getting 3.3% essentially in that case scenario. So that's why I call it a hidden cost. And I talk about consider renting if you're only looking for a short-term situation. Like right now, I'm looking at moving where I'm at, and I only need to be here for another 3 years and until my youngest graduates high school. And then from there, I don't know exactly where I'll be. So that's where renting is kind of making more sense for me, where I'm selling a house that I own and I am renting a place, personally. That's just kind of the thought process that goes into it. So, just in full transparency, I like to tell people when they're asking me my opinion on things, I like to show them transparently where my feet are planted. If I am, owning or if I'm renting, and right now I own 2 houses, so I'll be keeping the one and I'll be, also renting. So that's, full disclosure. So it's not like I'm anti-owning, but you just want to make sure that you have a long-term plan for the property that you're in. Obviously, the other reasons why you might own, even if you're unsure of how long you're going to have it, is if you have an other need, like if you want to house a dog that's considered an aggressive breed or what have you. If something would restrict you from being able to live the way that you want to live, if a landlord is going to tell you no, then ownership is just up yours to the landlord. Like, no, you can't tell me what I can and can't do. I'm just going to go another way. But just understand the cost behind it, where if you're not there for a long enough time, what's happening right now, like this was talking about with the soft market, meaning it's a strong negotiating thing for buyers to come in and offer less for homes. That's totally true in this environment. However, the sellers are not desperate to sell. So they're holding on with very low interest rates that we saw just a few years ago. And, if they're holding on with a 2 or a 3% interest rate, they could alternatively rent the house out and be landlords rather than sell the property. And that's what a lot of them have decided to do. So I've just kind of been looking at the market as a whole. But for those of you that have been kind of scrolling through, hi, my name is Kenny. I'm newer to TikTok. I'm not new to lending. I've been lending since 1999. And in that time, I have been a great resource to help people structure deals, to, figure out their, with their loan originators and real estate agents, I'm able to help them structure the more complicated deals. That makes me well qualified to answer any questions that you might have. And then I also have the ability to price out any deals for you right here live on TikTok. I was reviewing the markets as well, looking at where interest rates are going. I thought this was a really interesting article down here. Government bonds safe haven status tested as Iran war drags on. I got my head in the way, but I thought that was a really interesting headline amongst all of these other ones, because that's what I was talking about, where in normal circumstances it's normal if there's a conflict or a war or something like that going on. It's normal for stocks to sell off, as they have been. That's normal. What's not normal is that bonds also sell off. That's considered the safe haven where the money would flow into. And when that happens, that creates lower interest rates. So it used to be that bad news was good for interest rates, and that's no longer the case. And then we look at where the money has been flowing to. And again, I'll move my big head out of the way here as we look at the last year of oil prices, where they were pretty steady around $60, and now boom, they shot up to 100, about 95 right now. So it's just kind of interesting to see how that has been moving. But I think that's a lot of that stock market money that's been selling off has been moving into oil instead of moving into bonds. So if I'm right on that, and who knows, I don't have, I'm just guessing along with everybody else. And so who the heck knows? But if I'm right on that, when things stabilize, that money will likely reverse out of oil. So oil prices would come back down, and that money would then flow back into the stock market or somewhere else. So whatever other asset looks most appetizing at that time. So who the heck knows? But I'm certainly just sharing with you my interpretation, my reading of the tea leaves, as it would be. But anyway, some more of the AI stuff that I've been kind of playing around with here. It says, what percentage of Americans actually own their home free and clear? And so if anybody has any guesses there, or if you're just kind of thinking to yourself, how many people out there own their house completely free and clear? I'm going to tell you the answer, but I want you to think of a number in your head and just think, is it more or is it less than what you're thinking? And the answer is only about 38%. 38. Thank you, Becky, for putting that question. So for Becky, she's thinking 15% own their homes free and clear. About 38% own it free and clear. So for her, she's thinking, well, that's more than I thought. But what is going on is, kind of like the average first-time home buyer, now being 40 years old, has just kind of, changed the dynamics a little bit about who is a homeowner. And so the homeowners tend to be the older, people that have this gray-colored hair, owning homes. And so a lot of these homeowners are, senior citizens. They've had their loans paid off because they've literally had them for over 30 years. Sometimes, it's not always, right? Some people refinance over and over again. And so there's plenty of elderly that have mortgages. That's totally fine. And then there's reverse mortgage and things that they can do to leverage that asset, to liquidate it and put it into other assets. But I thought that was kind of interesting. I was actually guessing personally that I thought it was going to be higher than the 38%, and it may have been more recently, but with the cost of everything going up, what that tells me, if I'm right, and this doesn't specify that at all, it doesn't give me a progression, it just gives me a snapshot. But if it was more than 38% and that's come down, that just means that more people have been tapping into that equity to buy other things, maybe out of necessity. That's totally speculation. But with the cost of goods and things going up, certainly possibility. Another thing I forgot to mention is, being newer to TikTok, all of those buttons over here certainly help out the channel. So if you like the content, feel free to give it a like. If you know anybody that is looking to buy or refinance in the near future, please share this with them. And follow if you want to be alerted when I come on live. I usually come on for about an hour a day, every weekday. And so that would get you alerted. And then I also clip these up into shorts so you kind of see the highlights as you're scrolling through. I don't know. I usually do my doom scrolling right before I fall asleep. I don't know about the rest of you, but I usually doom scroll right around about 11 p.m. is I'm taking my melatonin and trying to keep my eyes open to watch the next scroll. You ever do that where you fall asleep and the scrolls just kept going and going, and then it wakes you up at 1 or 2 o'clock in the morning and you must have rewatched this video on accident about a million times? Been there, done that, got the t-shirt. But yeah, any questions, mortgage or real estate related, feel free to shout it out. Otherwise, I'm going to move on to the next AI question. And let's see what it says here. What is the highest 30-year mortgage rate in U.S. history, and when was it? So a lot of us, if we're thinking about, what interest rates did back in like the 70s, a lot of our parents or grandparents talk about, oh man, interest rates used to be so dang high. They're right, because the answer does put it in 1981, October of 1981, and they topped out for a 30-year loan at 18.63%. But in full context, that house was probably like 50 grand. So I would much rather have a $50,000 house at 18% than have to pay, $1 million or whatever they're going for now at a 6% rate. So I think they did just fine. I'm not feeling too bad about their 18.63, but AI goes to comment about how tough that would be, but leaves out the context about the actual cost of the asset. And then the other question it had is it true that banks make most of their money in the first few years of the mortgage? Now, this is something that we've talked about on the channel quite a bit. So I think the average consumer understands rate really well, and they're saying, what are the interest rates on whatever. But where people don't have as much education on is the cost of amortization. So when you make your first payment that you're paying almost all interest and almost no principal. And then by the end of it, it's reversed. You're almost paying all principal and no interest. But bankers are going to bank, and they understand that the average consumer is going to pay off their loan, whether it's through a refinance or whether it is because they're selling the property, but every 7 years, the loan is typically paid off. So that's where they're making most of their money in the amortization schedule. And the way to combat that, it's more difficult in the state of Texas because they have funny rules about their home equity line of credit. But there's a special loan that sometimes gets a lot of funny names on TikTok, like home equity accelerator or something like that. But it's really an all-in-one loan, meaning there's two components to it. One is it's a home equity line of credit. That's your first lien on the property, which is a unique form in and of itself. And then the second component is that it's tied to a checking account. And the way it attacks your amortization cost is if you're a high income earner, when you get paid, it immediately goes and pays down your mortgage the amount that you were paid. And so you no longer are paying interest on the amount that you just paid down immediately, right? Because you're charged daily on interest. And then it's tied to a checking account, so it's not like you're out of cash just as your bills are, as they are due, you go ahead and then borrow some of that money back by spending out of that checking account that borrows against the home itself, the home equity line of credit. And so that's the way that loan program works, and it's fighting amortization. And even though that rate is higher, there's a ton of illustrations because it's going to be different based on how much debt you have and how much income you make, because you need to have, that being paid down quickly. I like that loan program only for the people who don't have a better asset to buy. Otherwise, if you have a better asset to buy, like I was saying, I don't think real estate is going to do in the next 10 years what it did in the last 10 years. There are better assets to look at. And I can't give financial advice, but I can tell you that the largest, mortgage company in the nation has a dividend paying stock that is a really good deal, in my opinion, at $5, and it's well below $5 right now. So that's just throwing a dart at the board. I'm not, I don't own any of that stock, but just throwing a dart at the board, I think that asset is going to do better than real estate in general over the next 10 years. Who knows? In 10 years from now, let's go ahead and clip this and see if I was right or wrong. But my hunch is that I would have been right on that. And that's where I'm just thinking that, reduce the amount of cost of housing, and then go ahead and, when people are asking me questions about if they should put more money down for down payment and things like that, my answer to that is no. Go ahead and finance the house and then take your cash and utilize your cash towards assets that are going to appreciate faster than homes. But with that, I'm going to ask for last call for any comments or questions as we're going to get on with our Thursday. Man, it's already Friday Eve and we're coming into the weekend hot. I'm going to get back to playing with AI. Some of the stuff that Claude did for me today is it identified an unused URL that I own that it's going to make into a beautiful website that I will tell you guys all about once it's ready to be unveiled. And it's actually going to take the transcript of this show and it's going to whip up an article, a blog. It's going to do a bunch of other things too for the people that reach out. It's going to just kind of give you just kind of a snapshot, like bullet points of what we talked about today, and remind you that I'll be on tomorrow as well for an hour and to tune in. So it's just kind of like acting as a little assistant of mine. I'm tickled by it because AI is just getting better and better, and it's really awesome to see. So I'm curious to hear how everybody's using AI in their lives. I know I was talking to someone earlier today that wanted to get rid of a couch, for example. And so I showed her how easy it is to just take a picture of the couch. I uploaded it to Gemini and said, help me sell this on Facebook Marketplace. And it made this crazy awesome ad where it like fixed the pictures. It did a close-up of the fabric with the hand kind of putting the hand on there so you can kind of see the finer grain of the fabric. AI is just freaking phenomenal. I love it. I hope you guys are having an amazing day. And like I said, I will be back on tomorrow. Thank you so much for tuning in, and I will see you tomorrow. Bye for now.
The market's moving, the rates are live. We're helping you through the 9 to 5, from application to keys in your hand, making home owning the best in the land. That's another rap on Mortgage Talk, helping you with your closing walk. From Texas to your hometown, we're keeping it real, making sure you get the best deal. Hit the follow, don't miss the next Show. We got the answers you need to know. Mortgage or cash, whatever your way. We'll see you back here for another day.
Thanks for hanging out on TikTok Live. This has been Mortgage Talk. See you tomorrow.